केकी मिस्त्री साहब बात कर रहे हैं, आइए सुनते पहले उनको, HDFC लिमिटेड के वाइस चेयरमैन और CEO, आइए उनकी राय सुनते हैं।
RBI further mandated that within a group, just one entity may be engaged in a specific product line. This would require a reassessment of the group structure. Secondly, RBI has harmonized asset quality reporting between the banks and NBFCs. Thirdly, in addition to the SLR on regulated deposits, HDFC is now also required to maintain a liquidity coverage ratio. Consequently, the gap between the liquidity requirements of a bank and an NBFC have considerably reduced. Also, NBFCs are required to move to a core financial service solution platform, which is akin to the core banking solution of a bank. Scale-based regulations could in due course further harmonize regulations between banks and NBFCs in future. So first is on the regulations. Second is, if you look at the CRR, SLR requirements for banks, these have reduced considerably over the years to the current level of 22% of the demand and time liabilities. Also, interest rates are significantly lower today as compared to earlier years, and hence the negative carry on raising funds to meet the CRR, SLR requirements will be considerably lower today. HDFC currently does not have a priority sector lending requirement, and hence as a part of the combined entity, HDFC Bank would have had to raise funds and increase its PSL requirement through direct lending in the area of agriculture and micro, small, medium enterprises industries. This would have had operational inefficiencies besides resulting in an additional negative carry. This incremental funding would also have carried an additional CRR SLR requirement. RBI has now permitted banks to hold priority sector lending certificates. These certificates are instruments that enable banks to achieve their priority sector lending targets without actually disbursing those loans. HDFC has non-convertible bonds of nearly rupees 80,000 crores, which have an original maturity of over 7 years. Subject to RBI approval, these bonds would qualify as affordable housing bonds and consequently would not carry CRR SLR requirements. Real estate over the years has become seen an increased level of transparency in regulations. Paramount among these are the Real Estate Regulation Act 2016, the Insolvency and Bankruptcy Code, and many other regulations that have been introduced. This has resulted in an increased level of activity by banks in the real estate sector, both retail and wholesale. Mortgages offered by the combined entity can be widely delivered in an efficient and profitable manner. HDFC will benefit from the lower funding costs of the bank and from its very large distribution franchise, while HDFC Bank will benefit from HDFC's expertise in the real estate space and its low and efficient processing of loans, which has enabled an 8.1% cost-income ratio. The amount invested by HDFC Limited in the capital of HDFC Bank currently has to be reduced from HDFC Limited's Tier 1 capital for computing the capital adequacy. This has a negative impact on the return on equity. And consequently, any future infusion of capital by HDFC Limited into HDFC Bank to maintain its stake at over 20% would have resulted in a further.
तो ये थे केकी मिस्त्री साहब जो बताते हुए इस मेगा मर्जर के बारे में इस विस्तार से